Yeah, then welcome to the second lecture. And the second lecture is entitled On the Great Benoit Mandelbrot. So still the leading verse here, and this lecture here, or let's say the subheading, the student is not above the teacher, nor the servant above his master. And I think today it will become clear why I chose that subheading here for this small lecture series. So, who was Benoit Mandelbrot? So he was born in 1924, passed away in October 2010. He was a Polish-born French-American mathematician and polymath with broad interests in the practical sciences, especially regarding what is labeled as the art of roughness. It's a physical phenomena and the uncontrolled element in life. He referred to himself as a fractalist and is recognized for his contribution to the field of fractal geometry. So he proposed a completely new field in mathematical science, which included coining the word fractal, as well as developing a theory of roughness and self-similarity in nature. And toward the end of his career, he served as Sterling Professor of Mathematical Science at Yale University. So, and this information here you will find if you Google his name and open Wikipedia. Yeah. So, his research had significant contributions also to the field of finance, which is probably something that you have not heard about yet. For instance, his book chapter entitled The Variation of Certain Speculative Prices, which is a part of his book Fractals and Scaling in Finance from 1997, has more than 10,000 citations. And the content from that book chapter is based on his research article, The Variation of Some Other Speculative Prices, which is published in the Journal of Business. So Journal of Business, for those of you who do not know, probably not, it was back in the days sort of the Journal of Finance. Yeah? It was considered a top-notch journal. And yeah, Benoit Mandelbrot, he unfortunately passed away. I think he was 85 when he passed away in October 2010 because he had some pancreas cancer. And it took just, obviously, if you have this type of cancer, you don't have much time. I think the average life expectancy once you have diagnosed that is sort of 1 month or so. So if you, on YouTube, you will find his last interview that he gave 1 month before he passed away. He has also 2 sons, actually, and both of them, as far as I know, they work as medical in medical science. And this actually is his book. He has written also a couple of books, and one book also for a wider audience in finance, and this is called The Misbehavior of Markets. This is a book that I can highly recommend you. If you read and understand that book, then that's all you need to know about financial markets. Okay. So here I have given you 2 different price series, or actually they are not that different, right? So Mandelbrot was the first who showed that cotton price changes are governed by what is called the power law process. And power law can be used to model the part of the distribution where extreme events may occur. And an important manifestation of the power law process is that they exhibit statistical self-similarity, which is sort of fractality in a time series setting, which is something that we are interested in financial economics. So, and well, what does that mean? You may wonder. Well, let's consider the following 2 time series evolutions. So, the first 2 are log price series of the Dow Jones 30 index. So one of the graph uses daily data, the other one uses a different time frequency, which is monthly data. And the other graphs which will follow, they plot the corresponding return series. Here you see the corresponding return series. Obviously, I took away the scale here on the left-hand side, okay? So you only see the evolution of the returns here, and here you see the evolution of the price series. So what's daily, and what's monthly data? Okay, you would need to throw a coin, right? Because you can't say.
Monthly budget.
Sorry?
Monthly data?
Yeah, it's either both. It's either daily or monthly. But from just steering on the data, you could not say what is what, right? What's monthly, what's daily data. Same thing with the return series. You cannot distinguish between monthly and daily data, but you see similar patterns, right? So that's self-similarity. So now we reveal what it is. So on the left-hand side, we have monthly log prices covering the data series from January 1939 until March 2022. And on the right-hand side, we have daily log prices, which cover the sample from 17th of January 1996 until 31st of December 1999. Yeah, so sort of a 3 years, roughly 3 years period. So, and this time window here that we have here, the whole time window, is what we see here, marked in the red box. Yeah, and we see these two blips here, yeah, which is what you see here. And you see this everywhere. So when you zoom in, if you have, let's say you have the log prices on a monthly frequency, and if you zoom in, you have the same patterns as if you would zoom out. Because here you could not say if this is monthly data or daily data, could you? No. But you see the self-repeating patterns. So the smaller part it looks like this, like the whole part. Yeah, and that's basically what this self-similarity or fractality is about. In nature, we see this all the time. So if you want to read a scientific book that is also written for the larger audience, a sort of popular science book on that topic, which is entitled Scale. I would recommend the book Scale, written from Geoffrey West, who is a physicist, and who basically the whole book is about power laws in nature. So there are many interesting, eye-opening things that he documents in his book, and one thing is that I found quite fancy is that, for instance, the branching in your lungs, okay, this is also it exhibits this fractal-like patterns, and so the lungs or the human body works as if we were in 4 dimensions, even though we are only in 3, because of this fractality. So this is a very interesting thing, and also obviously in finance, this plays a huge role. Which brings us to someone else. Now we move from Benoit Mandelbrot to Vilfredo Pareto. So we go now back in time. The Italian Vilfredo Pareto, born in July 1848 and passed away in August 1923, he was known as a civil engineer, sociologist, economist, political scientist, and philosopher. So obviously he had a wide interests. And like Benoit Mandelbrot, Pareto accomplished several important contributions also to economics, especially in the study of income distribution and in the analysis of individual choices. So he was like sort of interested in everything, also in women. If you read his, which may be not surprising because he's an Italian, but if you read his like information documented on him, then you will figure out. And he was the first who discovered that income follows a specific power law distribution, which is nowadays known as the Pareto distribution, or the Pareto 80-20 law that you sometimes, or the Pareto 80-20 rule, which you sometimes read about. So the Pareto 80-20 law was built on Pareto's empirical observation that in Italy, 80% of the wealth belonged to only 20% of the population. Yeah, so a small fraction of the people own the vast majority of the land. And yeah, so the classical Pareto distribution in its original form postulates that 20% of the largest observation of a data sample make out 80% of the overall total. So in his case, he was interested in wealth, in the distribution of wealth, so or income. Okay, but you can take that same principle to any other data set as well. If income would be Gaussian or normally distributed, so whenever I talk about Gaussian, it's the same like normal distribution. Okay, so it's sort of synonym. So if in a Gaussian world, which is what the majority of finance scholars uses in modeling their data, 20% of the largest observation would make out only 44% of the overall total. Yeah. So obviously, the Pareto distribution generates a much higher level of concentration in the data. So the Gaussian distribution cannot generate this kind of concentration. It's much more even distributed. So here we have some example that I gave you, and just that you get familiar with the difference, how we can think about the differences between the Gaussian world and the Pareto world. So we said, okay, 20% of the cumulative largest observation in the Gaussian world, we said, okay, they make out 44% of the cumulative total. You sum up all the observations, okay. In the world of Pareto, they make out 80%. Okay, and then we can ask. So I think obviously I simulated here a huge data set. Okay, large data set, law of large numbers can be applied. So if I use, and then so I simulated a huge data set, and then I took first the largest 20% of the Gaussian observations, and what I did was obviously I multiplied negative values with -1 because I wanted to have only positive values. Okay, because the Pareto distribution is only defined for positive values. So then I sort the normal distribution, and I sum up the largest 4% of the observations, and then I divide it by the sum of the total. And then I figured out, okay, so 4% of the largest observations in the Gaussian world make out 12% of the cumulative total. And what is 4%? Is obviously not, I didn't came up with it by chance. There was obviously some logic behind it. So it's 20% of 20%. Yeah. So if we are in the world of Pareto, 4% of the largest observations make out 64% of the total. So much more, much higher level of concentration. And what's 64%? It's 80% of 80%. 12 is not 44 or 44%. So we cannot apply the same principle here for coming up with this number here. So and now we can ask, okay, how much make out the largest 1% of the distribution on the cumulative total? If we are in the Gaussian world, 1% of the largest observations, of the largest, say, returns, because we are in finance here, right? They would make out only 3.6 of the cumulative total. So what does it mean? So, well, if the world is Gaussian, the large observations do not really matter, right? It's what is in the middle plus minus 1 standard deviation. That's where life happens, okay, in the Gaussian world. If we have the Pareto distribution, the classical 80-20, okay, 1% of the largest observations make out 50% of the total. A very small number of people, they own the vast majority of the wealth. Yeah. So what's 50%? It's 80% of 64%, or 80% of 80% of 80%. And what's 1%? It's 24% of 24% of 24%. So, and now you see already the logic, how these power laws are working out, okay? There's this self-similarity, because this 64% behave the same like the 80%. And this so you can basically apply the same logic here, and you can exactly, you know exactly what is the fraction of the next iteration. Okay, it's different here in the Gaussian world. And I know we can maybe illustrate so that you know roughly what we will most likely come back to that later on. But okay. So usually the power law is defined for there's some cutoff, some minimum value, okay, that we need. And then depending on the exponent, if you have a low exponent, like what we will learn is that in the case of Pareto, it corresponds to a power law that has an alpha exponent of 2.1. So it is a distribution that has a very long tail. Okay? If we are in a Gaussian world, it looks different. You remember from last lecture, 6 sigma events are basically impossible to generate for a normal distribution. It's not impossible for a Pareto distribution, because the tail is much longer. There's probability density here that you do not find in the normal distribution. So, and yeah, as I already mentioned, the Pareto 80-20 is one specific distribution of a whole class of distribution with this term power laws. And it's defined as what? Okay, we have the probability density, P from X, and C, which is a constant term, times X to the power of minus alpha. And this C, this constant term, is a function itself from the exponent and this cutoff here, this X minimum value. Yeah. And the exponent is defined for values larger than 1. Otherwise, this guy here is not defined. It's as simple as that. And the X values for which this power law is defined, they must be larger or equal with the minimum value. Okay? So the function is only defined, which you also see here from this graph here, for values that are here on the right side. This builds the support here, the right side on the x-axis, which starts at the minimum value of x minimum. And now we have let's take a different example. So this we know already. Let's take an exponent that has a value of 3. We will learn later why is that important. So let's say we consider now an exponent of 3. So if we simulate data, or we can also calculate it. If you can take the integral, you can everything that you do via simulation, you can also do analytically. But I think it's perhaps easier or more convenient to do it via simulation, because now we have computer power. Since we have computers, we don't need to think, right? So if you have an exponent of 3, 20% of the largest observation make out 45% of the total. And 4% of the largest observations make out 20% of the total. And what's 20%? It's 44% of 45% of 45%. The largest 1% of the observations make out how much? 9%. And 9% is what? It's 45% of 20% or 45% of 45% of 45%. Same iteration. And here, obviously, it's the same thing like previously. We start with 20%, and then we know, okay, 20% of 20% or 20% of 20% of 20%. So we can, using these iterations, once we know the starting value here, let's say the largest, we know the fraction of how much do the largest 20% make out of the total. We know exactly that we can, using these iterations, we know also we can measure the concentration in the next iteration. So that's quite simple. Yeah. So each power law has a unique and repetitive scaling behavior. This is called scaling behavior. Yeah? That is governed by the same rule. And here the rule is, okay, 45% of 45% of 45%, and so on and so forth. And before that, it was 80% of 80% of 80%. So, and it becomes evident here that a power law generates extreme events, which corresponds to an extremely large fraction on the cumulative total. Yeah, and again, here, recall this guy here, this Pareto, has an exponent of 2.1. So we see already now, as the economic magnitude of this exponent, of this alpha, increases, okay, the concentration that the distribution generates decreases. Exponent 2.1 generates, if we now only consider, let's say, the largest 1% of the observations, it generates a concentration of 50% for this 1% of the largest observations. If we move from 2.1 to 3, it generates only 9%, yeah? Which is much less, obviously, than 50%. But it's still much larger than the normal distribution. Okay? So that's something important. So it's an important distribution class, and you will find it everywhere, in nature, everywhere in nature, and also, not unsurprisingly, also in finance, especially in finance, or in man-made, let's say, environments. They're typically governed by some of these power laws. And also something interesting, yeah, okay, you might have heard about Bitcoin at this stage, okay? I mean, you know, obviously your generation, you know, is something that you deal with, perhaps. So, Wilfredo Pareto, okay, this was almost 100 years ago. It was, I think, he published his study in the Journal of Political Economy in 1896. I think it was 1896, where he basically figured out that, okay, 20% of the largest, of the wealthiest people, okay, they have 80% of the total wealth. So this large concentration in the wealth distribution. This was more than 100 years, 120 years ago. Nowadays, it hasn't changed, by the way. It's still the same. But Bitcoin, yeah, which was according to the developers built, you know, as a means of payment, okay, of electronic cash and all this stuff. So we see it's the same level of concentration. So it's even more concentrated, actually. So 1% of the biggest wallets, Bitcoin wallets, yeah, that keep the largest amounts of Bitcoins in their digital wallet, they earn more than 50% of the total. It's even a higher concentration. So a lot of people are fooled, so that a very small fraction of Bitcoin users can be wealthy. But this is just a little side information for you. So let's move on here. Real-life evidence from the S&P 500. S&P 500 is, for finance people, a very important index. Okay, it somehow reflects how the economy is doing. Okay, because these are the 500 leading, biggest and leading companies in the U.S. and usually big players, multinational players. Okay, and if the economy is doing good, okay, prices of the S&P 500 rising. So, and what did I do here? So we said earlier, okay, each power law has a unique and repetitive scaling behavior governed by the same rule, and so on and so forth. Here, what we see here is on the left-hand side, okay, we see the price evolution of the S&P 500 over 100 years. Okay, I collected data from December 1920 to December 2020, exactly 1,200 observations, monthly observations. Okay, to large sample set. So the gray line. So let's start with the black line. Okay, so the black line is the evolution of compounded returns. So what are compounded returns? So let's. There's also something that finance people usually don't get. So, and I'm not talking about you. I'm talking about my peers, okay, my other scholars. So okay, let's say we have a return. We start here somewhere at time zero, t0, and here's time capital T. Let's say we have a return of 0, 0, 0 in the first 3 time units. Then we have a return of minus 50%. And then we have a return of 0, 0, 0. Then we have a return of minus 50%. Okay. Then we have a return of 0, 0, 0. So we start here. Let's say here at time 0, at time t is 0. In the starting point, we have a value of, let's say, 100 euro, $100, or 100 whatever Bitcoin. Okay. So okay, after. Here nothing happens, okay, in the first 3 time units nothing happens. Then we have a return of minus 50, okay. The price drops to 50. Now we have only 50 money units in our pockets. Then okay, nothing happens. Next 3 time units we have 0 returns here, and then minus 50 again. Okay, so from this 50, we have to subtract 50%, then now we are at 25. And then we have again 0, 0, 0. So what's the compound return? The compound return is, okay, we started with 100 at time t is 0, and at time capital T, we are here, it's 25. So, yeah, so we lost 75. If you sum up the returns here, we are at, you would think we have minus 100. But the compounded return will be then, yeah, we have moved from 100 to 25, so 75. Minus 75% is the compounded return. Yeah. So if you have money invested in stocks, you are interested in what? You are not interested in the average of the daily returns here. You're interested in the compounded return. You invest money, and then if you take the money back, okay, then you want to see the evolution. How has your invested money grown at the end of the time, at capital T, when you go in pension? That's what you want to know. What's your invested money worth then? You're interested in the compounded return, not in this average return here. So, and this is exactly what I have done here. I compounded, I computed the compounded return of the S&P 500. Okay, so you can use, of course, the evolution of daily returns to compute the compounded return.
The second minus 50% is based on the first minus 50%. When we calculate
from that value here, that's the price of your asset.
Yes.
And then you see in the news, okay, minus 50%.
Second
and that means, okay, the value of your asset decreased from 100 to 50.
Yes. Yes.
This is what it means. So what I did then is, okay, the black line here illustrates the evolution of the compounded return of the S&P 500 from 1920, starting at 0. Okay, and then I deleted the 1% of the observations from the sample, like only 12 observations that had the highest economic magnitude. Yeah, which means at the same time they had the highest volatility in these months. Because if you square, obviously if you square It's a rough measure for volatility. So if you do that, what you will figure out is, okay, that 1% of the largest observations in this 100 years, they make out 51% of the total compounded return. So if you, okay, let's say, if you would, because all of these obviously were linked to negative events, or most of them. I don't remember 100%, but I think most of these 12 events were negative returns, which is maybe not surprising. So if you would have known before that next month you will have a huge negative return and you would have put your money back on your bank account, and after that month would invest it again in the S&P 500, you would end up here. Okay? But because you didn't know that, you end up here. Yeah? So you lose basically 50% of the hypothetical income. Yeah. So you see, like I wrote here, this gray index here, it consists of 99% of the observations. Yeah. So always when the for each of these 12 largest observations, I put in a 0, because I wanted to see here what would be the hypothetical evolution of the compound return if you exclude these extreme months from the sample. Yeah, you see, obviously, a very small number of events, like 12 from 1,200, have a huge impact here. These extreme events obviously have a huge impact on the compounded return, on the cumulative total. And what's that? We just talked about it. What's the distribution that governs, that tells us, okay, 1% of the largest make out 50% of the total. Yeah, it's Pareto. It reminds us to the Pareto 80-20. So what are the implications if some parts of an asset distribution is governed by a power law? So once again, let's just that you get a deeper understanding what's actually going on here, what I'm talking about. We have now a red. Let's just consider one side of the distribution here now. Okay, we can do it for the other side as well, for the negative return. So let's say in the normal world, normal distribution tells you, okay, your positive returns are distributed like this. Okay, and the same obviously here for the negative returns on the other side. So, but this is not the truth. This is not how it looks in real world. So in real world, there's here some value. Okay, there's a different, with a certain probability, there's a different rule applying for financial data. And if this rule applies, the probability density does not look like this, like the normal would suggest. It looks then all of a sudden different. It looks more like this. Okay. There's less probability density here, but there's more in the extreme. Recall from last lecture, we had the normal distribution suggests 0% of the probability here. There's nothing. There's no Six Sigma events. But we see 0.13% are larger than in the economic magnitude, larger than Six Sigma in the empirical data of the Dow Jones 30 index, right? So there are events, obviously, that the normal distribution does not account for, but in real life we observe them anyways. And these events have a huge impact that we have seen here. So we model only some part of the distribution by the power law, not the whole distribution. It's a part of the distribution. Of course, there are also distributions. It depends on what asset class you consider and on many different other things. But usually what I'm talking here is that there's a part of the distribution that it's followed by a different rule. And this part is obviously the important part, because all of the others is just noise, more or less. And this distribution, I mean, you might have encountered that already in high school, maybe some of you. So you have in school this long math and short math, right? And those people who have this more intensive math courses, you might have encountered that at some point. At least you know how to compute integrals. So this is something that everybody learns in school at least. So if you have this kind of distribution here, that's the probability density, and it starts at x minimum, okay? So if we take the integral from x minimum, that's the starting value of the function, until infinity, then we can compound the first moment very straightforward. So we just plug in the function, what it is, times x, and then dx. Once we do that, we come up with this expression here. So the first moment is defined, so it's the expectation of the return for the return is larger or equal to x minimum return. Yeah, and then it's just the exponent minus 1 over the exponent minus 2 times the minimum value for which the function is defined. In the same manner, we can compute the second moment, the theoretical variance, which is the theoretical variance, okay? So now we're interested in, okay, what's the expected mean for the returns for this part of the distribution, okay? And we are also interested in sometimes, okay, what's the variance for that part of the distribution? And then in the same manner, in a similar manner, we can compound again, we use the integral. And what we will see is then, okay, the variance is defined as what? It's the exponent minus 1, again, over the exponent minus 3 times x minimum, the x minimum value squared. And we can generalize that. If we do this many times, we will figure out, okay, all moments, so moment x to the power of k, so let's say the third moment, you just have to plug in here for k3, and here for k3, and here for k3, and you can compound all moments very easily by just plugging in the number that you're interested in. If it's the first moment, you plug in 1. If it's the second moment, you plug in 2, third moment 3, and you can easily, using this formula here, compute the corresponding moment. So whenever you talk in finance about payoffs or returns, it's the first moment, of course. If you talk about variance or risk, then you talk about the second moment, right? So the first two moments are essential for finance people and for the whole finance theory. Because everything is derived basically in the mean or the reward, which is the payoff, and risk, which is the variance or volatility space. So what are the implications if we are still interested in the implications? Yeah, if some parts of the distribution are governed by a different rule, yeah, by a power law, by some power law rule, so it becomes evident from the formula that we have just seen that the mean only exists for an exponent larger than 2. And the theoretical variance only exists for an exponent larger than 3. Yeah, you can easily see it from here. Yeah? If that is less than 2, there's no mean. There's no mean. Or of course, if you have a sample, we can always compute a mean, but the mean has no meaning. We cannot interpret it. We cannot use it. And you cannot tell your customers at the bank, okay, we have your investment would produce this type of payoff, because mathematically it's not defined. So, and here we see, okay, because we have in the denominator here for the variance alpha minus 3, alpha must be larger than 3 so that the variance is defined. If alpha is 3, 3 minus 3 is 0, and this becomes, we cannot divide something by 0. Okay, so the whole expression becomes undefined, which means, in practical terms, it's infinite. Yeah? So very simple. So you can, once you see these formulas here, you know exactly, okay, this must be larger than 2, otherwise it's not defined. This must be larger than 3, otherwise it's not defined. So he was the first who found that cotton price changes. The cotton prices, he wrote a paper, a study in the 60s, and there cotton obviously played a role as a commodity, still, at least. So he found that the tail of cotton price changes is governed by a power law process with an exponent of alpha less than 3. And if you read the study, he has done that for the positive values. So he saw that he did it for the positive side of cotton price changes and for the negative side. So for both parts of the distribution, he estimated that this exponent that governs the distribution of the cotton price changes for the negative payoffs and for the positive payoffs, the exponent is less than 3. And also, he did that for different frequencies. He did that for daily changes and also for monthly changes. Same thing, same exponent, regardless of the frequency that you have. So, and if the exponent, if this power law exponent is the same or about the same, there's always some uncertainty in the estimates, of course, because this is what data, real life data is. But that's prima facie evidence of a power law behavior. And yeah, he showed that this result that alpha is less than 3 held regardless of whether positive or negative price changes were considered, and regardless the time frequency. But this is a very interesting and strong result. So if you read his original paper, he uses a slightly different, much more complicated model. Yeah, so he has in his model he has a different exponent. But if we translate his model to the easy model that we use and that many other people in finance are using, yeah, the exponent is less than 3. I think in his paper it was 1.7 or something like that. But again, he uses a different function. So, and what many people do not know, but now you know, that Eugene Farmer, who won the Nobel Prize in 2013, he was Benoit Mandelbrot's doctoral student. And if you read the book from Mandelbrot, that the misbehavior of markets, on page 96, Mandelbrot himself documents. He's now talking about the follow-up research that has been done in the wake of his paper, where he published the results of cotton price changes. The inquiry quickly broadened beyond cotton. Whatever the stock index, whatever the country, whatever the security, prices only rarely follow the predicted normal pattern. My student, Eugene Farmer, investigated this for his doctoral thesis. Rather than examine a broad index, he looked one by one at 30 blue-chip stocks in the Dow Jones. He found the same disturbing pattern. Big price changes were far more common than the standard normal model allowed. Large changes of more than 5 standard deviations from the average happened 2,000 times more often than expected. Under Gaussian rules, you should have encountered such a drama only once every 7,000 years. Okay, so once in 7,000 years. In fact, the data showed it happened every 3 to 4 years. Every 3 to 4 years, we have extreme events. Yeah? In the normal world, this would never happen in a lifetime. So, Eugene Farmer knew about that. In 1963, Farmer, he wrote a comment in the Journal of Business, in the same journal where Mandelbrot published his study on cotton price changes. And the study the comment from Farmer was entitled Mandelbrot and the Stable Paretian hypothesis. On page 421, Farmer himself wrote the infinite variance assumption, which means alpha is smaller than 3, has extreme implications. From a purely statistical standpoint, if the population variance of the distribution of first differences is infinite, the sample variance is probably a meaningless measure of dispersion. Moreover, if the variance is infinite, other statistical tools such as OLS, what finance scholars use most of the time, which are based on the assumption of finite variance, will at best be considerably weakened and may in fact give very misleading answers. So Farmer knew that if the variance is not defined, yeah, for some part of the or for an important part of the distribution, we cannot use OLS. It makes no sense. Okay, because what's a point estimator? It's a covariance between your asset and the index divided by the variance of the index. If the variance is not defined, there is no point estimate. Point estimate is not defined either. You cannot use it. Of course, if you have a sample, you could always get a point estimate, but this point estimate will be always different if you expand the sample or different time windows. Okay, so there's no real point estimate. Let's say that's only like a illusion of a point estimate if the variance is not defined or infinite. So that's a big problem in finance. Figured out 1963, exactly 60 years ago. Yeah, you are exactly 60 years ago. So next year, next year in the RFM course, I cannot say that anymore because it's now in 2023, and 60 years ago that was published. So, and I think it's interesting to note that, especially given the fact that Farmer, even though he knew it better, so he knew that standard assumptions do not hold for financial data, because he did his own doctoral thesis on that topic, okay? So he knew all that. But he chose to follow in his later research stream the other Nobel laureates, yeah? Like Merton, Scholes, Markowitz, Sharp. That means he employed OLS regressions. Although he writes here himself in the 63 paper that it gives very, very misleading answers, according to his own statement from 63. So, I mean, what's going on here? Okay, that's kind of weird, don't you think so? So, well, I figured that when one does not have accurate information, because if you would ask Farmer, okay, he would probably deny that. If one does not have accurate information on why someone acts the way he or she does, one can apply the following principle from Jordan Peterson. Who of you knows Jordan Peterson? Young people like you, usually they know Jordan Peterson. He's sort of like a prophet nowadays. Okay, gives some guidance for young men and so on, you know, who are a little bit like lost. So I mean, obviously this Jordan Peterson, I mean, yeah, he's quite famous nowadays. What people do not know is that he makes about $8 million per year. Yeah, with all of his business, so he makes a business out of that. I mean, that's perhaps okay. I don't know, but you know, but you have to think about, okay, those people who you know watch all of his stuff and so on, and who pay for his lectures and attendances and books and all this stuff. These are people who perhaps need some help. Okay, so. Yeah, so it's a little bit how to put it. So he of course he perhaps provides added value for some people, but he gets also paid for that, and he takes that money from those who already probably are in trouble. So he's not like Robin Hood, okay? So, but he has probably some good points. But he's obviously very very smart guy and very. Let's say articulative, so he knows how to speak and how to make his points. So, but and his books are obviously also they have they are solid, I would say. That's solid. He always refers to solid science, and he has read many things. I think he has done a good job as a researcher as well. But yeah. So in his book 12 Rules for Life, he wrote, I believe it was Young, this was some psychologist back in the days, who developed the most surgically wicked of psychoanalytic dicta. If you cannot understand why someone did something, look at the consequences and infer the motivation. This is a psychological scalpel. It's not always a suitable instrument. It can cut too deeply or in the wrong places, all right? It is perhaps a last resort option. Nonetheless, there are times when its application proves enlightening, and I think so too. So if we consider Eugene Fama here as our example in finance, Eugene Fama's career in academia. Yeah? So what's the consequence of following correlation-based methods and OLS and all this stuff? So one obvious consequence for stepping in Robert Merton's, Myron Scholes, or William Sharp's footsteps, as opposed to Benoit Mandelbrot's footsteps, was that he won the Nobel Prize in economics, yeah, for his contribution, like the others, yeah, in 1907 and 1990. And all of those works share one commonality, which we have already seen in the first lecture. And this commonality is that they use methodologies that do not work out in financial markets, given the very nature of financial markets, which we discussed here. Yeah? So all of these guys, they use methods derived from the normal distribution, which makes no sense for financial data. We have seen Eugene Fama's study on contributions for which he received the Nobel Prize. We showed it doesn't hold if you expand the sample or in other economies. The factors are not existent, basically. So people, obviously, are willing to do many things to receive fame or recognition from peers. So why not deceiving some naive peers by deliberately using methods that demonstrably deliver misleading answers, like Fama himself wrote in a comment. So Fama would have had only the opportunity to pursue what people might call an academic career if he followed the rules set by the lobby that dictates the rules of the game. So Markowitz published his portfolio selection paper in the Journal of Finance, which was considered the state of the art in 1952. Sharp and Lindner and these collaborators, they developed the capital as a pricing model based upon Markowitz's portfolio theory. And the whole research stream followed Markowitz already, which is obviously based on the normal distribution and correlation-based methods. So that was the state of the art. These were the people who were deciding who goes on in the academic hierarchy and who does not. Mandelbrot came out with his research findings in '63. This is more than 1 decade later. So the lobby has already applied different rules. So, and if you read the study from Hu et al., yeah, the study is entitled "Replicating Anomalies." So these guys, they investigated whether cross-sectional asset pricing phenomena, if they hold up to currently acceptable standards for empirical finance. So they investigated 452 asset pricing anomalies, and they were based on 111 research papers, and most of them published in these top-notch journals. Okay, so 82% of those 452 asset pricing anomalies fail scientific replication. So this implies that more than 80% of what you read in these scientific journals isn't trustworthy, because the vast majority of those research results reported therein doesn't hold in other samples, or future samples, or other geographic samples, which we have seen already in the first lecture, right? So, and what does that mean? So it means that 20% of the studies, they produce 100% of the signal. Okay, because 80% is just noise. We have 100 research papers, 80% is noise. Only 20% actually deliver something that can be used for something, okay? So that's why you can say that this 20%, this remaining 20% of the papers, they produce 100% of what makes sense. So it's a much more concentration than the Pareto 80-20, right, in academia, which may be surprising for you. So, and what are the implications? So we are still in the applications here. So there is a review article entitled Financial Power Laws, Empirical Evidence, Models, and Mechanisms. And this article was conducted from Thomas Lux, and his collaborator in 2016. And Thomas Lux, he is a professor of international economics at the University of Kiel in Germany. And actually, it's interesting that I had actually a couple of lectures when I was a master student in my major studies, because I studied at the University of Kiel back in the days. So I had actually some lectures at Lux. But back then, I didn't understand that he was actually performing research on power laws already back then. This is something that I figured out later on. But obviously, he has a huge amount of literature, of studies in this field of research. And he actually developed something that is called theory for herding behavior. So herding behavior, because so I'm more interested in, okay, how can we model data, financial data? Okay, what's the exponent? Okay, because once we know the exponent, we know many things already. But Lux is more interested in what generates this power law behavior in financial markets. So he's coming up with some sort of theoretical models, and one of these models is this herding behavior, for which he has received quite a lot of recognition among peers. So in this review article, he inferred from studies on power laws in financial market data over 30 years, because obviously in the wake of Mandelbrot's study, there were many follow-up studies coming, okay, and all of the studies found different exponents, okay. Some confirmed Mandelbrot's findings, and other said no, the exponent is much larger. So, and in this article, they wrote that the majority of researchers, they gradually converged to the insight that the exponent is roughly 3, as opposed to less than 3, which is what Mandelbrot originally found for cotton price changes. So, and if you go back now here to this formula, so we see if it's in the neighborhood of 3, let's say 3.1, then first moment and second moment is defined, right? So your return, if you have an investment strategy, okay, and you figure out, okay, exponent is, let's say 3.1, okay, you have a mean, you have some mean that you can compute, and you can compute also the risk in terms of the variance, because it exists here in finance. But that's not 100% true, as you will see. But this is what people think. So this is what finance scholars usually think. They think, okay, if the exponent is 3, like around 3, like let's say 3.1, then everything is all right. We can continue because variance exists, we can continue using mean variance framework and continue, because then everything, if the variance exists, well, then everything, if the sample is just large enough, we can use the normal distribution, because everything will converge to the normal distribution if the sample is just large enough. This is what finance scholars think, or what they will tell you. But there's also another viewpoint on that issue. So here I write, okay, if the theoretical variance exists, yeah, many scholars believe they can use OLS or other correlation-based methods that require the variance to exist, like Sharpe ratio or something like that. But Taleb, which is this guy here, and Nassim Taleb, he wrote a couple of interesting books. I don't know if you are familiar with his works. He wrote the book Fooled by Randomness. He wrote the book The Black Swan. And he wrote the book Skin in the Game. All of these books are very interesting reads. And he was back in the days an option trader, and he made a lot of money in 1987, for instance, when we had this 22 sigma event, okay, when in October 1987, when we had all of a sudden, when the stock market went down on one day, huge negative return, and he had he bought far out of the money options that generated in a huge payoff as the market collapsed on this one day. So after that, he didn't need to work anymore, but he continued working anyways, because he had this, he developed his own trading strategies and made a lot of money with these tail events, that normal models do not allow for. So he made a lot of money with that. And actually, he also wrote research. He wrote research studies with Mandelbrot, so they were friends, sort of friends, or at least acquaintances, let's say. And he actually, all of his books. So first, I read his book, the Black Swan, which I found very interesting. But through that book, I actually figured out that it was actually Mandelbrot who was the father of all that. It was not him. He was just sort of he used Mandelbrot's insight and wrote books about it and for popular science, so that everybody can understand that. Okay, but the idea comes from Mandelbrot. It's not his idea actually. Yeah, but he also wrote a book that you can access online for free, and it's called Statistical Consequences of Fat Tails. It was a very interesting book, but it's more written for statisticians or for mathematicians. It's not easy. The first 50 pages you can read and understand, but then it goes things become very hard. But I think if you read the first 50 pages, more you don't need to know, because all the rest is just that he elaborates more in detail and derives mathematically his points. Okay, so he does the math, because he is a mathematician actually in his background, and philosopher as well. But you know, all of these people, obviously, Philo Pareto, Mandelbrot, and they're interested in somehow in many things. Okay. So he argues in his most recent book, it is not so. Yeah. It's not so like many finance scholars believe it would be, that if the variance is finite, okay, alpha exponent 3 is roughly 3, okay, we can use normal distribution, because in large samples everything will converge anyways to the normal, so we can just use our correlation-based methods. But he writes, no, it's not so. The reason is simply we cannot possibly talk about Gaussian if the kurtosis is infinite, even when lower moments exist. Further, if the exponent is close to 3, which is what they figured out here, okay, but the vast majority of scholars, but the consensus of the scholars. So, but if that would be true, if the exponent is close to 3 and variance exists, the central limit theorem operates very slowly, and it requires the n, which is the number of observations that you need, of the order 10 to the power of 6 to become acceptable. Not what we have in the history of financial markets. So what does that mean? So if you have the normal distribution, if you have random drawings from a normal distribution, yeah, you need about, if you have a sample of 30 drawings, okay, you can compute the mean of that distribution and the variance. You can take the sample mean and the sample variance, and it gives you accurate information about the population variance and the population mean. So you can use the estimates from the sample as the corresponding theoretical values for mean and variance, and you can then you can compute obviously also this confidence interval, okay, and then you know, okay, with 95%, let's say, confidence, yeah, you can use this sample, then you will get some sample mean mu hat, okay, and you get a sort of a variance, and you can then compute a 95% confidence interval, and then you can say, okay, mu, like the true theoretical mean of that distribution here that has generated these 30 drawings, is with 95% probability in this and this interval. Yeah, and this interval that you computed using the empirical sample mean and the empirical sample variance. You need only 30 observations, and you can get an accurate estimate. But if you have a power law process that has with an exponent close to 3, so let's say 3.1, you need 1 million observations in order to have the same accuracy that you have with 30 observations if the data is Gaussian distributed. This is what he means. This is what he's telling us here. Sometimes he's a little bit difficult to understand, but this is what he means. So, but we do not have so much data. I told you the largest data set I could find for the Dow Jones 30 is about 150 observations from some suspicious website that is probably not even allowed to have that data, because usually on free websites you get maybe, I don't know, 30, 40 years of data. But there are some websites that give you the whole data set that is actually available. And so I found 150 years, so back until 1870 or so, data for Dow Jones 30. And I had daily data, so roughly 37,000 observations. But you would need 1 million to actually have so that you are in the position to make some inference here. Yeah, to give to know something about the actual mean of your distribution. Yeah. So what does that mean? So, well, let's go back to the formula. So what does that mean? So alpha 3 is not enough to be able to make, let's say, some sort of accurate inference. Kurtosis is the fourth moment. Yeah? Mean, variance, skewness, kurtosis. Kurtosis is the fourth moment. So the fourth moment only exists for what k must be larger than 5. If k is larger than 5, if we have a power law with an exponent larger than 5, we can use the normal distribution. Okay, or we can say we can operate, let's say, with correlation-based methods, because then we only need sort of 30 observations, and we can make the same sort of inference like we could do with 30 sample drawings from the normal distribution. Yeah, but as the exponent decreases in the economic magnitude, we need exponentially more and more observations. So this is something important to bear in mind. Okay, and many finance scholars they don't get it. They just don't don't get it, because they need the variance to exist, and so because all of the models, all of the theoretical models, they are based upon mean variance space, and they just pretend that we know something about the variance. So what are the implications if you use wrong models in practice? I mean, in theory, okay, theory, as long as theoretical finance remains theoretical finance, it's okay, because people don't care. People most likely don't even read this. Most people don't even read all the studies. And if only, let's say, theorists read theoretical papers and build upon new theories, and as long as it doesn't harm anyone else, who cares, right? But if you use these models that are taught in business school in practice, things are different, because someone has to pay the bill. So here's one. This is just one out of many. Okay, this is just because this is crazy what happens here. So, but in real life, you can just Google. I can give you even more examples, because 2 years ago there were Credit Suisse. Right, it was Credit Suisse who almost who took a huge hit because some hedge fund went bankrupt. But well, so but this is even more fancy here. So he writes in his book, The Black Swan, on page 281, 283. Robert Merton, and again he was a Nobel Prize winner in economic science, right? And Myron Scholes, he also was a Nobel Prize winner, were founding partners in the large speculative trading firm called Long-Term Capital Management. You can Google that. Or LTCM. It was a collection of people with top-notch resumes from highest rank of academia. They were considered geniuses. And recall, they developed this option pricing formula. So the ideas of portfolio theory inspired their risk management of possible outcomes, thanks to their sophisticated calculations. They managed to enlarge the ludic fallacy to industrial proportions. Then, during the summer of 1998, a combination of large events triggered by a Russian financial crisis took place, surprise, surprise, took place that they lay outside their models. It was a black swan. LTCM went bust and almost took down the entire financial system with it, as the exposures were massive. Since the model ruled out the possibility of extreme events or large standard deviations, they allowed themselves to take monstrous amount of risk. The ideas of Merton and Scholes, as well as those of modern portfolio theory, were starting to go bust. The magnitude of the losses was spectacular, too spectacular to allow us to ignore the intellectual comedy. Many friends and I thought that the portfolio theorists would suffer from the fate of tobacco companies. They were endangering people's savings and would soon be brought to account for the consequences of their Gaussian-inspired frameworks or methods. None of that happened. Instead, MBAs in business schools went on learning portfolio theory, and the option formula went on bearing the name Black Scholes Merton. Do you know how much money that LTCM lost? Well, it was about $7 billion. And who was supposed to pay the bill? The taxpayer. $7 billion in 1998. It's if you take, let's say, a corresponding amount of money in nowadays society. I don't know how much would it be. 100 billion? I don't know. So, but it was back in the days. It was a huge amount of money. Okay, and if they would have not received help, then the U.S. economy would be probably blown away. Yeah, and this is just one example, but this is just so interesting because the founding partners were Nobel laureates. Okay, So intellectually, they were considered geniuses, okay? But you see, yeah, they published in the Journal of Finance and so on, yeah, in these recognized journals, yeah. So that was because this makes it even more, let's say, weird, okay? But there are also many other hedge funds who actually went bankrupt, and I can give you if you want, I can give you more examples, but this is just interesting because the founding partners were Nobel laureates, okay? So so if disciples, if students from these people are running hedge funds with the same methods, it should be not surprising at all if hedge funds once in a while blow up. Okay? It should be no surprise. What else can we say? Well, it was perhaps before your time, but you can ask your parents. 2007, 2009, financial crisis. Here in Finland, I've heard from my wife and my wife's father that here in Finland it was no big problem. Because Finnish banks are usually all right, have good risk management. Finnish banks are, let's say, risk averse. They run their business more, let's say, pessimistic. You know, they want to, have they do not take excessive risks. Okay, this is sort of in the Finnish mentality, which is a good thing because Finland didn't suffer that much. But other countries, Iceland, Sweden, large banks, the Swedbank almost went bankrupt. Germany, Commerzbank was state-owned afterwards. And in U.S., Lehman Brothers went bankrupt. Another bank went bankrupt, and it was then bailed out. So, but that's not the thing. The thing is that obviously there were some banks or some institutes that anticipated the bust of the overconsumption in the housing market. Okay, and what did some banks do? Well, banks managed to bundle those worthless mortgages. Okay, they bunched them together and sold them as CDOs, collateralized debt obligations. Okay, so they sold them as high quality products to other institutions that were fooled. So, and the collapse of the financial system and the subsequent economic downturn, it was inevitable. So, and what you can do is, so if you use the wrong methods that do not account for tail risk, you can transform crap, let's say it was B minus bonds or mortgages, you can transform them into A-star credit derivatives. And other people are fooled because they do not know the risk that is actually behind it. And well, the sad story is, like we had in the previous example, that ordinary folks suffered from the consequences. And on top of that, they were supposed to pay the bill. The taxpayer was supposed to pay the bill. It's always the same. So, and it is, and that's, and now we come back. So why did I choose this verse taken from the Bible here? Student is not above the teacher, nor a servant above his master. Yeah. So Mandelbrot's research actually it holds scientific replication. And we will come back to that now in the forthcoming lectures. That's science. Yeah. Farmer, he was Mandelbrot's student, but he put himself above them. So he, despite of knowing it, or he should have known it better, because he was Mandelbrot's student and he wrote his doctoral thesis on that topic even. Actually, Mandelbrot also wrote in his book that Farmer came to the conclusion, when he wrote his doctoral thesis, that we would need much more than 30 assets, which is what you will typically learn here in classes. You just need 30 assets, then you have a good risk diversification, right? No. Farmer figured out already back then, in the early 60s that you need much more than 30 assets in order to have a risk diversification. Because of what? Because the tail of assets is governed by a power law. And it makes the assets much more risky. So, but Farmer, he chose to follow other Nobel laureates like Merton, Scholes, Sharp, right? And as a consequence, his research turned out to be rather scientism. You cannot use it. You cannot even replicate it. It doesn't hold, as I have shown in my own research, it does not even hold in other geographies, in other samples. Yeah. So that is why I chose this. Yeah. Mandelbrot did not win the Nobel Prize, but Farmer won it. So what's the Nobel Prize worth in economics? You can think about that. So in the next lecture, we will talk more about recent empirical evidence for power laws in realized variances. So we will talk a little bit about my own research that I have conducted. So there's of course I have a motivation for why I did that. So if you use realized variance or realized volatility, it's often used also in the finance industry actually, and it gives us, or there's literature saying that realized variances or realized volatility give us more information than as if we would derive the variance from simple returns. Yeah. So and if you use realized variances or realized volatility in a time series framework, so you use, let's say, you use the trading days, you use the sum of square trading days in a month, then you have an estimate of the realized variance in that month. You can do this for every month. You have a sample over certain assets. So you have the realized variance of certain assets, and you can work with that. You can estimate, for instance, the underlying distribution of that. And you may come to different conclusions as if you would use just the simple return. Yeah. So, and yeah, this is what I have done a little bit in my own research, and I have actually published these articles in quite decent, in quite good journals, and that's why I would like to present some of my own stuff here. And who knows, maybe also some of you might find this interesting. And in the last lecture, I will hopefully I will have time for that. That I will show you how to, let's say, how to access certain codes, because there are obviously some people who have already provided some pre-written codes for that. How you can easily, let's say, use programs that give you the estimate of the exponent from a certain data sample. Yeah, so you can do many things with pre-written codes that have been done from people in computer science or mathematical science that are reliable. Yeah, I hope you enjoyed this lecture, and the next lecture will be on Friday, as far as I'm concerned. Thank you.